Good morning, everyone. This is Adam Welch here with Insurance Agency Marketing Services. We are coming up here at 10 o'clock, so we're going to go ahead and get moving here. I want to thank everyone for taking a bit of time out of their Monday morning here to join me this morning. We will be taking a look at tips for ongoing management of life insurance policies, so specifically looking at policy reviews and some things to look out for and how this could implementing a policy review process in your practice could lead to new opportunities here. So I had said we are here at 10 o'clock, so we're going to go ahead and get moving here. Before we get into the meat of today's discussion here, today's webinar, I just want to quickly go through and talk about some great things we have available here and going on here at Insurance Agency Marketing Services. A couple of items here for some of those of you that may be newer to us here at IAMS, not necessarily new to the business, but new to us here at IAMS. We do have some great incentives out there for you to take advantage of. The first being our new producer bonus. So this is a way of rewarding those of you that are new to us and for writing your first pieces of business with us. We have 3 different levels for our new producer bonus for you to take advantage of. The first one being the $100,000 level. We have $300,000 level and $500,000 level. Now, please keep in mind, once you do hit one of these levels and you choose to take advantage of the new producer bonus, at that level, it's not a ongoing incentive there. So once you claim it at one level, you can't go forward and claim the next one. So, but just quickly looking through here, some of the options available to you at the $100,000 level, you see a $750 cash bonus, or a 2-year subscription to our website and newsletter service, or the latest generation iPad that's available for you to take advantage of. The $300,000 level, you see their full Social Security program and a 3,000 piece postcard mailing, or a $2,000 matching marketing money to promote your business. So taking advantage of some marketing reimbursement there, or a $1,500 gift card. The $500,000 level, we have available a 5,000 piece mailing and seminar coaching with Matt Gill. Matt is one of our top producers, always qualifies for all of our trips and incentives. He uses some really powerful seminar marketing and has had great success with it, and he will make that available to you with that 5,000 piece mailing. Go through the seminar training with Matt there so you can implement that into your business. Additionally, we do have another seminar system with Dave Pemper. Dave, again, another top producer of ours, always qualifies for all of our incentive trips. And at the $500,000 level, you can choose that 4,000 piece mailing and seminar coaching with Dave Pemper. Or you can choose to create your own getaway, get out and relax. You can choose that Ritz-Carlton travel rewards and create your own personal getaway there. So that's our new producer bonus. Again, a way of us saying thank you for your business to new producers here with IAMS. Another great incentive we have available for you here is our annual top producer escape. This is our top producer trip. You can see the dates there for the next one. This will be out at the Boulders Resort and Spa in Scottsdale, Arizona. It's a great location, some great golf, great spa, and great scenery there out in Arizona. But it will be February 25th through the 28th in 2018. You can see the qualification requirements down at the bottom of the screen there. Basically, any business that you write with us here at IAMS, we will recognize that and give you credit towards our top producer trip. So you can see you can qualify with any combination of $2 million in annuity premium, $1.5 million in single premium life, $175,000 in target, and you can see some of the other qualifications there. The qualification period did begin July 1st, 2016, and it runs through the end of this year, December 31st, 2017. Another great incentive there to place your business with us here at IAMS. We do appreciate it, and we will give you credit and recognize that in our top producer trip. So very attainable qualifications there, and it should be a great trip. So we look forward to seeing everyone out there on that trip. Creative services. So our creative department here has a number of different options available for you, help you kind of brand yourself and brand your business. You can see a number of different options, but Josh in our creative department does a great job in building up some branding and developing print marketing, online marketing. You can see the different options available here, but our creative department is here to help you. We've gotten some great feedback. The folks that have taken advantage of our creative services here really have great things to say about the work they do and how it's been able to help their business. So if that's something of interest, if you don't have a website or you want to do some online marketing or print marketing and want to take a look at what we can do for you here, we do have some options available. Please feel free to give us a call and ask for Josh in our creative department. Email newsletters, again, stick them with the creative services here. If you're not doing email marketing, that is definitely becoming the preferred way of marketing here. And you see that stat there, 86% of internet users 65 and older do use email. So email newsletters, web leads. I'm not sure if any of you are taking advantage of web leads, but again, Josh in our creative department can help you out with your online marketing and your newsletter and web lead marketing there. Okay, we are big on training here at Insurance Agency Marketing Services, and in addition to the webinars that we do, we really like our IAMS Life and Annuity Academies. These get great responses and feedback, and quickly here I'm going to talk about the Academy, but I do want to launch a quick poll here about our Life and Annuity Academy. And I really encourage everyone on here just a quick yes on that poll. We can get some additional information out to you. There's no obligation, but basically this is a all expense paid 2-day marketing seminar. It's off-site, so we will take care of a flight, hotel, and all of those expenses for you. Our upcoming academy here was just scheduled. It will be held May 17th through the 19th, so we'll fly in on that Wednesday, have a quick meeting, grab some dinner and kind of get acquainted with everyone. That Thursday, we will have a full day training session. Matt Gill and Dave Pimpers, we saw from the previous slide, they will be out there going over their seminar marketing and their approach and their sales techniques. This is definitely not a 2-day product training. This is more of a sales concept and process-oriented training session to help you grow your business. So we bring you out here for a few days, and our hope is that you will take at least 1 or 2 pieces of information back to you. Maybe it's a new software program or a seminar system, whatever the case may be. We want you to bring some piece of information back to you, back with you to your office to implement into your practice and help you grow your business. So again, it's an all expense paid trip there to that training meeting. Will be held this May 17th through the 19th. So it looks like we did get a number of you participating in the poll. Thank you very much. If you've not yet answered that poll question, do highly encourage you to click yes. Again, it's no obligation. We can just get some additional information out to you about that academy and let you take a closer look at it. Registration form out to you if it is of interest. Just need to fill out that registration form, get that back into us, and we can take a closer look there. So, all right. I'm going to go ahead and close this out so we can keep moving here. So thank you to those of you that did respond to that. We will get that information out to you here after the webinar. Okay. Paperless contracting. This is really a huge time saver for a lot of you out there. We've gotten great feedback on our efficient paperless contracting. If there's ever any carriers that you want to get appointed with, it's really just a matter of filling out our agent data packet once, getting that back to us. We will keep that information on file for you, and if there's ever any carriers down the road that you want to get appointed with in the future, it's just a matter of calling in, visiting with your marketer or anyone here at IAMS and letting them know that you'd like to get up and running with the XYZ carrier as well, and we can get that taken care of. A vast majority of the carriers that we work with do support paperless contracting. So it's, again, just a huge time saver and a great way to be a bit more efficient there. It saves the hassle of filling out more paperwork for each and every carrier out there. So that is our paperless contracting. Our website here, you can see www.iamsinc.com. This is a great resource out there for you. There's a number of items available for you on our website. From sales tools, our term quoting engine. You do have the ability to quote, to generate term quotes right up there on our website. In fact, all of us in the life department, when you do call in for term quotes, we hit our website there. So it's that is available to you out there. Of course, it's available 24/7. You can generate forms or contracting forms online. And take a look at our annuity, life, and LTC product grid and get a snapshot at current rates and some of the more relevant products that we're working with here at IAMS. So that's our website, www.iamsinc.com. IAMS Wealth Management. This is something relatively new here, but many of you may be aware of the Department of Labor fiduciary rule that's kind of looming out there. Not sure what's going to happen with it here, but basically IAMS Wealth Management, we established an RIA here at IAMS to help with that managed money business and to be a bit more proactive in terms of preparing for the DOL rule here. So again, we're not sure what's going to happen here, but this is just another value-added service that we have available for you. If you are currently in a current investment advisor representative or considering adding that to your business, we definitely encourage you to reach out and at least visit with our staff here at IAMS Wealth Management. You can see the number down at the bottom of the screen, 888-255-7670. We have a full onboarding package available to you. If you're currently licensed or if you're not currently licensed, we can work with you to get your appropriate licensure, the Series 65 license, and get you up and running and add assets under management to your offering and to your business. It's a great way to kind of set yourself apart from some other agents and advisors out there. So again, that's IAMS Wealth Management, 888-255-7670. If you'd like any more information on what we can do for you there, please call in and ask for Charles Jr. He would be the primary point of contact for our RIA arm. So, Retirement Analyzer software. This is a great software program that we have available to you. It's Retirement Analyzer, but it's really more of a holistic planning tool to use with your clients. So you can see the 6 questions that it will answer for your clients down there on the bottom. But this has been a great tool to really show the impact of making a few changes and then the impact of a product that you're recommending within your client's retirement plan. It also addresses life insurance needs, LTC needs. So it's, again, more of a holistic planning tool, but it's been a great piece of software. Those that are using it, I know really do enjoy the simplicity there that it does provide, and making presentations to the client and showing the overall impact. And it's not just selling a product, it's selling a whole concept and how showing how that product will play into their financial future. So that is available. Please feel free to give us a call here if that's of interest to you as well. Okay, Easy Money Now. Last couple of items I want to mention here before we get into today's topic of discussion is our Refer Producer program. You can see on the left-hand side of your screen. We appreciate your referrals, as I'm sure you appreciate referrals from your clients. They are the most qualified lead. It really says something about you and your business when you receive a referral. So we want to reward those of you that are kind enough to send over some other agents in your area or that you're acquainted with to us here at IAMS to do business. We will give you $50 when your referral contracts with us with one or more carriers through IAMS here. Then we'll pay $100 or more when your referral writes business with us. You can see there in that example, that bonus can be thousands when they write their business through us. So in that example, if you refer over 3 producers, and all three are $1 million producers. They write $1 million in single premium life or annuities. You can see that be $6,000 cash bonus for you in your pocket. We pay out really large bonuses here, and a lot of our producers do take advantage of this. This is a great way to kind of supplement your income. So we do appreciate your referrals. If you have anybody you'd like to refer over to us, please give us a call, talk to your marketer. We'd be glad to work with them, and we will certainly reward you for that referral when they contract and do business with us. And then on the right-hand side, you can see our marketing reimbursement program. This is a great way to help cover some of your ongoing business costs. And for whatever reason, not a lot of, well, shouldn't say not a lot, but a majority of our agents don't take advantage of this. So we want to make sure you're aware of that. Great way to help cover some of your marketing expenses. So if you are an IAMS contracted producer, we will pay $200 in marketing reimbursement dollars. So it's a marketing reimbursement. It's your own account. That's your money to do what you wish, as long as it's related to growing your business. We will pay $200 in marketing reimbursement dollars in your account per $100,000 of annuity premium or single premium life premium that you write with us. So if there's ever a client appreciation event, or you do a mail drop or a seminar, send us the receipt, and we will cut your marketing expenses in half with that marketing reimbursement account. So keep that in mind. A great way to accumulate some marketing dollars there, and that you can use to help grow your business. So referred producer program and marketing reimbursement, a couple of great ways to great items to take advantage of here with us here at IAMS. So with that, we are going to dive right into the topic of today's webinar, and that is ongoing policy management here and how it could potentially lead to new opportunities for you. So my background came from actually performing reviews and assisting in the management of in-force life insurance policies. It's a great need out there, not only for those in the fiduciary capacity, but anyone that is selling life insurance that has clients with in-force life insurance policies. Implementing a simple policy review process in your practice can pay huge dividends in a number of areas, and good customer service to possibly uncovering some new opportunities for you, and some new opportunities to help your customer improve their situation here. So what we're going to talk about here today, I want to touch on why use annual client reviews. So when we talk about the policy review, we're really talking about an annual client review going hand in hand. So we're going to talk about why use annual client reviews and why implement that process into your practice, why policy management is needed, and really why it's needed more than ever today than ever before. We'll look at the actual policy review, so I'll give you some tips on the information that's needed for a policy review and what to look out for with each policy. And then finally, we'll touch on some policy remediation. This is where it could lead to new opportunities for you as the advisor. So firstly, talking about why annual client review. There are a number of reasons to conduct an annual review with your client. Those of you that have been with us here at IAMS for a little while, I know you've probably heard us say, at least on one occasion, you need to be doing client reviews. You need to stay on top of your clients and stay in touch with them after the sale. And that first reason there, it's good customer service. So it's going to keep you in regular client with your contact, at least on an annual basis, is what I would recommend. It's going to keep you in front of your client. It's going to keep you keep your name front of mind as a trusted advisor. So when you're meeting with them, there's an update on life-changing events, perhaps off-cycle. If you're not meeting with them at the annual review, but off-cycle from their review, they have a change in life events, they need some more insurance, or they need to make a change to their insurance, it will be your name that it will be your name that your client is thinking of versus the next agent that's knocking on their door or calling their phone. So keeping regular client contact and keeping you in front of them as a trusted advisor. Using an annual review, as I just mentioned here, gives you an opportunity to get updated on your client's life and any life-changing events that may have taken place since you last saw them. Maybe your client got married or divorced, or they just had a kid. Those are all changes in insurance needs, and an opportunity for you to bring up the change in insurance needs and help them address those needs. Update on existing insurance. So going back to the client got married or got divorced, making sure that policy ownership and beneficiary designations are up to date and recorded correctly may seem like a minor paper pushing task, but that is hugely important out there. It can save your client a number of headaches and the family a number of headaches by making sure that the beneficiary information is up to date and those policy proceeds are going to the correct parties. Fourth item there you see, review and manage in-force insurance. So doing the annual review allows you to do a review of the in-force life insurance policies. And then finally, referrals. Referrals. Every time you are in front of your clients is an opportunity to ask for referrals. If you're regularly in contact with your clients, they view you as a trusted advisor, there is no reason why you shouldn't be able to ask Mr. or Mrs. Client, who are 2 or 3 names in your network that you could introduce me to that would be interested in learning more about me and the type of work that I do. So every time you are in front of your clients is an excellent opportunity to ask for referrals. Great way to build up a referral-based business. So in addition to your seminar marketing or whatever you may be doing, referrals, as we had mentioned earlier, they are the most qualified lead out there. So, all right, so why policy management is needed today and really more than ever before. So that first item there, innovation has led to more complicated products. And I say complicated, innovation has led to more sophisticated products. So over the years, life insurance companies, they've gotten creative and have come out with new life insurance policies with more bells and whistles, different ways that they can perform. It's all great. It's vastly for the benefit of the consumer. It gives you some new things to sell with new policy features for the carriers you represent. But the fact of the matter is, they have become more sophisticated and complicated products, and the average consumer is not going to understand everything about that life insurance policy. So they do need the ongoing management with those more complicated ins and outs to make sure that policy is performing like it was originally intended and making sure that it will be there for them when it matters most. So today's policies definitely need the ongoing oversight and management of policy performance and the adequacy of policy funding. Those two kind of go hand in hand here today. And we'll take a look at why here in just a minute. Today's insurance, it's no longer just insurance. Many times there's often a separate strategy that's sold in conjunction with the insurance. So the insurance is just the vehicle for the strategy. And here I want you to be thinking the infinite banking concept or private financing, however you want to refer to it. Maybe it's using overfunding a universal life policy to help supplement retirement income. So a lot of times there's a strategy involved, and it's not just insurance. You're not just selling a death benefit most of the time. There's a separate strategy there, and the insurance is the vehicle to get you there. Especially in those cases, you need to stay on top of that policy and monitor it and make sure that it's being managed appropriately. If it's the infinite banking concept, okay, are we servicing the loans like they were originally intended? Making sure those loans aren't spiraling out of control. So staying on top of the strategy, making sure that policy is going to perform as originally intended. And then finally, just doing a checkup of carrier stability. This is an important issue, but it's certainly not the most threatening issue to life insurance policies out there, but at least checking up on the insurance company and the carrier ratings, financial strength, etc. Okay, here, so life insurance evolution. This is not meant to be a chronological representation of how life insurance policy has kind of evolved over the years. This is more so supposed to be a representation showing how insurance companies and their innovation and development of product has led to the transfer of risk from the insurance company shoulders to the policy owner's shoulders. So working here left to right, in the early days, we had whole life insurance, term life. That was really about it. Whole life insurance, supposed to be some of the most simplistic insurance out there. At least in the early days, you pay the premium, and as long as that premium was paid, that policy was guaranteed to stay in force. It was just based on, it fell back on the insurance company's claims paying ability and that whole story. So you pay the premium, that policy is guaranteed. The insurance company bore most of the risk to make sure that that policy was going to stay in force, because the policy owner did their part. They made that premium payment. Fast forward several years to today, and you have the universal life and the different offshoots of universal life. So for a number of different reasons, there was some innovation there from the traditional whole life participating policies where they paid dividends. We had the interest sensitive policies where it was based on looked like a whole life policy, but there were some aspects of a universal life policy in there with the crediting rate. And then you get to universal life. We're not going to get into why and some of the events that transpired that developed that innovation, but in today's life insurance market, we have the universal life. We have the different offshoots from index UL to variable UL policies. So basically what happened with the universal life, and I'm thinking just fixed current assumption ULs today, there's a crediting rate. There's cash value component. So we introduced some flexibility there with the death benefit and the funding to the policy owner. Oh, okay, Mr. and Mrs. Policy Owner, you can't make that premium payment this year. No sweat. You can skip it this year and pick it back up next year. You can't make that full premium payment. You can only pay half of it this year. So there's some flexibility introduced with universal life, and the cash value component of the policy, a little bit more control was shifted to the policy owner over that policy and whether or not it would stay in force. So as long as there was cash value in the policy, basically it would stay in force. But you have the crediting rates, and a lot of those policies issued 10, 15 years ago were issued at really high crediting rates, especially by today's standards. And those policies that are still in force today from that time, those crediting rates we know have bottomed out to more than likely their guaranteed contractual minimums, and they're not performing quite as well, and they're running out of gas. They're running out of cash value. So it fell more to the policy owner to make sure that cash value was going to be above zero, and there was going to be enough to keep that policy in force. Move forward down the line here, and we have the index UL, we have the variable UL, so shifting even more control to the policy owner on how interest is going to be credited to that cash value, be it an annual point-to-point strategy in an IUL, or to one or many mutual fund subaccounts and VULs in the separate account there. So basically what I'm getting at here is as the control shifted to the policy owner to make sure that cash value was going to remain in that contract, risk also shifted to the policy owner as well, away from the insurance company to the policy owner. Because of this, policy management is definitely needed more than ever today. So as you're going through and conducting a policy review with your client, some of the key review categories to take a look at, these 4 areas are the main areas where risk can really kind of rear its head in any life insurance policy. So the first item we want to look at is the policy funding. And here we're looking at the amount of and method of premium payments. So how much are the premiums? How are premiums being paid? So universal life policies, those are going to be paid more than likely out of the policy owner's pocket. Whole life policies, you can get a little creative on how premiums are paid. So policy funding, how much and how are premiums being paid? Secondly, you want to look at policy performance. Funding and performance really do kind of go hand in hand here, but here on the performance side of things, we want to look at the cash value accumulation as well as the charges and fees. So is the cash value growing like it was originally projected to? Are we on pace with whatever strategy that we needed to supplement retirement income, or is the cash value going to remain in that universal life policy so it's going to stay in force? The charges and fees that the carrier is charging. COI charges, that's really kind of hot button issue right now. You may know last year there were a number of big name, well-known, very reputable companies out there that increased cost of insurance charges on certain blocks of their policies. A significant enough increase in COIs and fees that are being charged can have a significant impact on policy performance and impact the policy funding. So a once adequately funded contract is now really underfunded here. So looking at all those items. Thirdly, the policy loans. Are there any loans existing on the policy? If so, what is the overall impact? Are they being serviced, or are they just being allowed to grow and recapitalize? And are we spiraling out of control here and running up against a policy lapse or an equity surrender? And then finally, the carrier stability, as we had mentioned, certainly important to make sure that the carrier ratings and financial strength is in line. But really, the carrier stability, that's of the 4 items presented here, that's probably the least of the risk that can show itself in a life insurance policy. So those are the 4 things to really take a look at with each policy review. So the first step in a policy review, we've got to obtain some data. Here, in the interest of time, we're really going to talk about the 2 main permanent types of insurance, universal and whole life here. It's all going to be fairly similar from base plan to base plan, with a couple of nuances here and there. But for today's topic, we're just going to look at general universal life policies and whole life policies. So the first 2 items that I have stars next to on the screen, we need to go out and obtain some data, and these are the 2 bare minimum items needed to complete a prudent policy review. The first one is the annual statement. The annual statement is going to give you a wealth of information from owner and beneficiary information, cash values at the last anniversary, whatever the crediting methods are, or what the sub-accounts are, whatever the case may be for those cash values. But annual statement will give you a wealth of information, and then an in-force illustration. So at bare minimum, we just want an illustration, an in-force illustration, that reflects the current funding method and current funding amount at the current rates and charge scales. So here, universal life policy, we want that current premium amount that's being paid reflected at the current crediting rate or illustrated rate and current charge scales. That's going to give us a good snapshot of and checkup of the policy's health as it stands today with the current funding. Whole life, we want to see the current method of premium payments. If it's premiums are currently being paid all by premium loans, okay, let's get a snapshot of that and see how it's going to pan out. If premiums are being paid out of pocket, okay, we need that shown at current dividend scales and the current dividend usage. So those are, at minimum, the 2 pieces of information to get a decent idea of where the policy's at today and how it's projected to perform in the future. From there, you can take it a couple steps further and request some alternate funding illustrations from the carrier. On the universal life side, you can look at a suspended pay. So if the client was no longer willing or able to continue making premium payments, what would it look like if they cut off premiums today? How long would that coverage stay in force? On the opposite end of the spectrum, you can request a minimum to maturity illustration. So what is the bare minimum premium that needs to be paid to keep that death benefit in force to maturity? From there, that allows you to have a pretty good conversation, show them a range. Here's your policy today. Here's what happens if you cut off premiums now. You want to increase premiums and keep it in force to maturity. Here's what's needed. So that can oftentimes be the first step to some remediation conversation and looking at some different options if there's some risk present. On the whole life side, similar scenarios there. Suspended outlay. So we know that whole life policies, that premium has to be paid, but there's a number of ways that it can be paid. It can be paid out of pocket by the client. It can be paid by using dividends or surrendering policy values or loans there. So looking at a suspended outlay, maybe it's cutting off out-of-pocket premiums today by surrendering policy values and then using loans to pick up the rest. And then on the opposite end, you can look at some alternate uses of dividends. So maybe dividends are currently being paid out in cash to the policy owner. Well, let's look at what would happen if we switch that to purchasing paid-up additions or reducing the premium. So some alternate funding scenarios can go a long way in a policy review with your client, show some different scenarios and help guide them, because life happens, and maybe what was originally sold is no longer appropriate now. So, all right, with that, just take a look at some tips here and what to look for based on each policy type here. So looking at universal life policies and the policy review, we want to take a look at first the funding review and then the performance review. So again, the funding and performance kind of go hand in hand with each other. The funding of the policy with universal life policies, really you can have three categories of funding adequacy here. Is the policy underfunded, meaning it's projected to lapse prior to the policy's maturity date? Is it adequately funded? So the premiums we're paying today, that's projected to keep that policy in force to maturity, or perhaps it's a desired age. A lot of policies today mature at age 121. Medicine has advanced quite a bit, but not that much to where 121 could be an issue if our client is still living. So, maybe you design a policy with a 121 maturity age to stay in force to age 105. At that point, the survival probability is so minimal, it's really not a concern there. So, is that policy projected to stay in force with that current premium to maturity or the desired age, perhaps 105? Or is the policy overfunded? Now, excluding the concepts of overfunding a policy to supplement retirement income in the future, are we paying too much for coverage? Are we just concerned about death benefit coverage and we're paying too much? So here, this is where requesting a minimum to maturity illustration would come in as a big help. If the current funding illustration is showing premiums of $30,000, and that's projected to keep it in force to maturity, but the minimum to mature illustration came back at $20,000. Well, you could save your client $10,000 extra dollars and possibly reposition that elsewhere. So is it overfunded? Are they paying too much for that coverage? So really those are the three levels there, and looking at the current in-force illustration can go a long way to helping you determine, all right, if coverage is running out, we're underfunded. We've got an issue here. We need to take care of this. Adequately funded, okay, we're good. That's no concern on the funding. Let's take a look at the performance and how this is performing here. So moving on to the performance, here you want to look at a few different items. The first being crediting rates or cap rates or participation rates. Of course, we're talking generally about universal life, but depending on the type of UL policy, did the crediting rates change from issue? Have they decreased, or have they gone up? Any changes from the prior review? So looking at the as sold illustration to today's current in-force illustration, what did those crediting rates or cap rates or those methods do? Cost of insurance. I mentioned it earlier today, but COI charges, they can have huge impacts on the performance of a policy and the cash values there. So were there any changes? Did your client get a notification from the carrier that their policy was going to be included in a class of policies that are going to experience a COI increase? Any other fees and expenses? So are these excessive? Are they in line with what's available out there? So maybe contacting us to run a comparative illustration for a similar policy type, kind of mimicking the in-force plan. So looking at the current funding, current death benefit, and current health status can help us identify if that policy, the in-force policy, is charging excessive COIs and fees and expenses. But again, if your client did receive notification from the carrier that their policy is going to be affected by a COI increase, as long as you're in front of your client as a trusted advisor, they should be reaching out to you. That's a huge opportunity to possibly reposition and do a 1035 exchange into a more efficient policy. It just needs to, at that point, I would definitely suggest ordering an in-force illustration and seeing how significant of an impact that COI increase would be. So first, we're looking at the crediting rates. Secondly, trying to get a pulse check on the COI and other fees, and then policy loans. So more common on the whole life side, but of course, universal life policies can be sold, as we had mentioned here, the supplementing retirement income and taking policy loans out in the future to look at that scenario. Did we take policy loans out? Are they being serviced appropriately? How is that impacting the policy? Just doing a checkup on the policy loans and making sure they're not threatening a policy lapse. And then looking here at whole life policies, fairly similar, but the funding of the policy, you're going to be looking for some different things. Whole life policy may not necessarily lapse. Here, an underfunded whole life policy may be a policy where increased out-of-pocket outlay is projected on that in-force illustration. So a lot of times this can occur from a term rider that's on the policy. Maybe there's a loan that's grown to be large enough that it's really impacting the policy, and they're showing that interest payments and principal payments need to be made on that loan to keep that policy in force and away from an equity surrender. So those items can definitely impact a whole life policy and could make it an underfunded policy. Is the policy adequately funded? So no outlay changes are projected. Looking at the performance of the whole life policy, looking at dividends here. So how are the dividend scales comparing to previous years? How are dividends being used? Is there a more efficient way to use those dividends? The term riders. As we had mentioned, if there's a term rider on there, maybe it's an annual renewable term rider, or it's a level term that's coming up to its expiration, and there's some increasing costs associated with maintaining that term coverage. Take a look at the overall death benefit. Does the client really need that full death benefit, or can we allow that term rider to expire and not pay those increased costs? And then again, loans. If there is a loan present, just taking a look at the overall impact on the policy, making sure it's not being allowed to spiral out of control, making sure that loan is being serviced appropriately. Okay, term policies. It's we talked a lot about universal and whole life policies, but if your clients have term policies, they can definitely benefit from an annual policy review as well. So from the term perspective, we want to take a look at premium competitiveness. Very easy to go out to our website here on our term quoting engine at IAMSinc.com and generate a term quote and take a look at the premium competitiveness for that in-force plan. How much are they currently paying? Is there any opportunity to possibly save some money? The level premium guarantee or the term period, is that nearing expiration? Are we going to bump up to skyrocketing term costs to keep that policy in force? Pardon me here. And then conversion privileges. Does the policy have a conversion privilege built in? If so, when is the last date that conversion right can be exercised before it expires? So making sure that you're staying on top of the conversion privileges there, and hopefully not missing an opportunity to convert that to a permanent plan of insurance. So looking at those items there with term policies can definitely be beneficial on an annual basis as well. So the policy review, we've gathered the information. We have the annual statement or the policy data page from the carrier. We have the in-force illustration. We sat down and took a look at it. What do we find? Well, the policy review would identify a troubled policy if you see a lapse on that in-force illustration, that current in-force illustration. It's underfunded, so there's an untimely lapse. That would be a troubled policy that you would want to address with your client. Identify their needs and goals and address that issue with them. Is it overfunded? So again, just as we talked, are they paying more for that death benefit coverage than they really need to, absent of a scenario where they're overfunding that for retirement down the road? Does the policy underperform competitive plans? So other similar types of insurance out there, is there something newer and better, a bit more competitive, that it would make sense to explore a replacement? And then COIs, again, are they excessive compared to competitors? So really kind of get a gauge there by looking at whether or not the policy underperforms competitive plans. If any of those items are identified, that definitely should lead into a discussion with your client about possible remediation options. So this is where it could definitely lead to new opportunities for you as the advisor. If there's an underfunded policy that's just not very competitive from a charge standpoint and cost standpoint, it's a very inefficient policy from that standpoint. Going into a discussion on these remediation options should be the next step here. So not focusing on base plan, but some generally available options available to most policies. We know with universal life policies, you have that flexibility to increase the funding or increase or decrease the face amount. So look at possibly increasing the funding if your client's willing and able to. Maybe decreasing that face amount, of course, within tax compliant constraints, but decreasing that face amount. Perhaps a combination of the two there, an increase and adjustment in the face amount. The fourth item, explore 1035 exchange. If there's something newer, a bit more efficient, has some more benefits out there that's available for your client that would make more sense and would be appropriate, absolutely explore 1035 exchange into something that may perform a little bit better and better align with their goals. Or five, look at a cash surrender. Maybe life insurance is no longer a prudent vehicle for them. They would prefer something that doesn't require the ongoing funding commitment that life insurance does. So you could look at a cash surrender and reposition those assets elsewhere. If any of those options are going to be considered, definitely recommend going through a suitability or a needs analysis with your client. So with every annual review, going out there to complete a policy review with your client and review their policy, I definitely would recommend bringing the original fact finder or the fact finder from last year's appointment out and updating that. As we had mentioned, life happens, and updating that fact finder can give you an update in their suitability and needs for insurance. Maybe kids are grown and out of the house and they're well off, and clients no longer concerned about as much death benefit for the kids. So maybe scaling it back or looking at some other options there. So updating that fact finder and completing that suitability and needs analysis definitely for any of those remediation options is highly recommended. And we do have a number of fact finders available out here for you. I will be calling to follow up with everyone, so I'd be happy to make some fact finders available to you as long as you are contracted with us here at IAMS. But we do have a couple of great fact finders I know a lot of our agents are big fans of that take out to appointments with them, so we can certainly make those available. At any rate, moving on here, I just have a couple of things before we wrap up and open it up for questions and get everyone on with their day. I just want to take a look at a couple of sample case studies and some examples here to get you thinking about some different ways that doing policy reviews can uncover some needs and uncover some new opportunities for you. So this first scenario here, we have a 67-year-old male. You can see up in the upper left-hand corner here, a 67-year-old male. We have a regular fixed universal life policy. So it's not index, it's not VOL, it's a current assumption universal life policy. Face amount is $1.2 million, paying approximate premiums of $23,000 a year for that policy. So the advisor went out, collected all the pertinent data, looked at the policy, and identified that the crediting rate has dropped significantly since policy issue. The cash value is decreasing rapidly, so that crediting rate decreasing, cash value is not growing as originally projected. Cash value is decreasing rapidly. That premium is not enough to keep that cash value up, and because of that, that current in-force illustration is projecting a lapse without increased funding. So taking that information to the client, the advisor went out and talked over the client's needs for life insurance and was able to identify that a lower death benefit would be more suitable. Client really didn't need that full $1.2 million anymore. In fact, the client was actually considering just suspending premiums altogether and letting the policy go. So he really wasn't interested in paying more to keep that policy in force. advisor talked with him about some potential options and said, yeah, you can certainly let that go, but you've paid those $23,000 premiums all this time. It would be a shame to just let that policy lapse without any value and getting nothing for that money. So you could look at a cash surrender or potentially a 1035 exchange into something else that would be more appropriate. In this case, the advisor recommended looking into a single premium life product. That way, there's not the ongoing funding commitment for single premium life as there is with traditional life. You're taking advantage of what cash surrender value is left in that current policy, moving that over into the single premium life plan. You have a paid up policy essentially. There's no more premiums due, and it's albeit lower than $1.2 million original death benefit, but it's a more appropriate level of coverage for that client. So he didn't need that full $1.2 million. So in this case, the advisor was able to take advantage of a 1035 exchange from the in-force policy that was projected to lapse, move that into a single premium life plan, and help the client take advantage of those premiums that he paid, getting something for what he paid into, and there's death benefit there for the kids at a more appropriate level. So very favorable outcome in that case study. The second scenario here, we have a 52-year-old female, again in a current assumption universal life plan, $500,000 face amount, and she's paying approximate premiums of $8,500 a year. So same deal, the advisor went out, collected some policy data, and identified that, again, we did have that crediting rate decrease. So, these were both plans. These were some older plans that have been in force over 10 years. So we had decrease in crediting rate since issue. And then this one was actually subject to a COI increase. So the carrier did send out that notification and fell victim to that COI increase. So really pointing to increased funding to keep that policy in force because of the increase in charges there. So after talking this over with the client, the agent identified that the $500,000 death benefit is still needed. It was purchased with intent and with purpose, and that's still needed. That need has not gone away or decreased. So we want to look at retaining a $500,000 death benefit. And she still really wants to keep that full death benefit in force. So she was definitely willing to increase premiums to the level needed. But after realizing that the goals were more aligned with death benefit protection versus cash value accumulation, the agent recommended exploring a no-lapse guarantee UL, a universal life policy with a secondary guarantee not designed to maintain cash value throughout the life of the policy. Accumulation is not an objective there. We just want that $500,000 in death benefit coverage. So looked at a 1035 exchange into a no-lapse guarantee UL. So, of course, this is a bit more in line with goals, with the client's goals. And policy is guaranteed as long as premiums are paid on time and in full with that no-lapse guarantee policy. And it's more of a death benefit-oriented product, which significantly aligns better with the client's goals. So in this case, she is paying a little bit more in premium, but it's a more suitable product for her in that no-lapse guarantee plan. So just a couple of case studies get you thinking about ways that you can uncover some new opportunities using policy reviews and annual client reviews. It doesn't necessarily have to lead to a life insurance sale. There could be some new needs for retirement income. So there are a number of items out there, but it's just great customer service to go out and see your clients on an annual basis, keep in front of them, make sure their policies are performing well, and the policies, especially that you sold them, making sure that they are going to stay in force and do a good job for them when they need it. So with that, I do appreciate everyone's time today and joining me here this morning. I know Monday morning can be a bit hectic for you getting started in the week, so I really do appreciate you spending your valuable time with me here today. With that, I'm going to actually check here for some questions. If you do have any questions, I apologize. I should have mentioned this earlier, but please type them in that question box and send them over. I will leave it open here for a little while. We've got about 5 minutes left here, but if there are any questions, please feel free to type those over in the question box, and send those over to me. So if anything may come to you after the fact, you can see our phone number there at the bottom right-hand corner of the screen, 800-255-5055. Please feel free to call in and ask for me. Again, this is Adam Welch. I work in our life marketing department here at Insurance Agency Marketing Services. Please feel free to ask for me by name or anyone in our life department. Be glad to help you out, answer your questions, and get you squared away. So, all right, with that, I'm going to go ahead and wrap up here. So thank you again, everyone, and look forward to talking with you soon. Take care.